The global financial landscape is shifting away from the predictable dynamics of the Great Moderation. We have entered a structural era defined by real-time systemic instability, where the old models of market behavior no longer hold. While the United States economy remains resilient, entering its fourth consecutive year of expansion, this surface-level growth masks a significant divergence occurring underneath. Different sectors are no longer moving in tandem, they are pulling apart. This high dispersion environment changes the math for retail investors. In 2026, a standard passive cap-weighted index fund acts as a concentrated bet on a handful of mega-cap stocks, rather than a diversified safety net. To navigate this, we must map the new macroeconomic drivers and reconstruct the specific asset allocation playbook currently used by major financial institutions. Understanding the mechanics of market dispersion is essential for identifying where capital is actually flowing and where the risks are concentrating. This map of 2026 regional projections reveals a structurally divided global economy. While the euro area and China struggle with stagnating growth and property downturns, the United States continues to expand. Real GDP in the US is projected to grow between 2.25% and 2.7%, driven by private sector investment and high employment. Fiscal policy is providing a significant tailwind. The One Big Beautiful Bill Act of 2025 is injecting over $170 billion in consumer tax relief, helping to offset the pressure of elevated energy costs and negative real wage growth. But that fiscal injection keeps inflation sticky. Core prices are hovering between 2.6% and 3.2%, well above the Federal Reserve's long-term targets. Under the new leadership of Chairman Kevin Warsh, the Federal Reserve has adopted a patient, hawkish tone to combat this persistence. Expectations for aggressive rate cuts have faded. The Fed has established a policy rate floor of 3.5%, marking the official end of the era of near-zero interest rates. This permanent shift in the cost of capital forces institutional investors to move away from speculative growth and towards assets that generate real, sustainable yield. The primary physical engine behind the current US expansion is the massive capital expenditure cycle in artificial intelligence. Major tech hyperscalers are deploying up to $750 billion in 2026 alone. At 0.8% of national GDP, this investment cycle is approaching the scale of the historical railroad and telecommunications booms. This chart compares reinvestment rates. AI-focused firms pour 30.6% of their revenue back into research and physical assets, more than double the rest of the equity market. This results in a projected 20% earnings growth edge for these firms through 2026. To fund this, these tech giants have shifted from being cash hoarders to massive debt issuers, accounting for nearly 20% of the entire corporate bond market. The investment focus has moved upstream. The focus is no longer just on software. It is on the physical hardware and the immense power grid capacity required to run it. This capital is now flowing into secondary beneficiaries: utility providers, power grid equipment manufacturers, and clean energy logistics. The evolution of technology into a heavy industrial sector is fundamentally altering how institutional portfolios are being constructed. The velocity of this AI spending has created a significant distortion in the standard market benchmarks, particularly the S&P 500. By mid-2026, concentration reached record levels. Just 10 megacap stocks now account for over 40. Semi-liquid private credit funds are promising investors regular redemptions while holding long-term illiquid loans on their books. This chart tracks the resulting stress. Write-downs on high-risk mezzanine loans have climbed to 13.3%, triple the baseline levels seen 5 years ago. In a sustained high-rate environment, these high-yield private credit structures represent a significant liquidity risk for unprepared investors. A second friction point is the ongoing vulnerability of the global energy supply chain. Conflicts in the Strait of Hormuz have the potential to spike oil prices unexpectedly. Such an inflationary shock would likely force the Federal Reserve to pivot back to an even more hawkish stance. Investors must also account for the volatility of the midterm election year. Historically, the first half of these years sees market corrections averaging 12 to 15%, as political outcomes remain uncertain. However, these pullbacks are historically temporary. As this data shows, the S&P 500 has a 100% probability of positive returns in the 12 months following a midterm election drawdown. Institutional investors utilize these credit stresses and midterm shocks as statistical entry points for capital deployment. By synthesizing the data on fiscal stimulus, AI infrastructure, and index concentration, we can define a clear framework for 2026. The first step is to deallocate capital from extreme cap-weighted indices that are overexposed to a handful of tech names. Shifting into equal-weighted factor ETFs allows an investor to capture the broadening earnings recovery while reducing the risk of a mega-cap reversal. This leads to the institutional equity strategy, the value growth barbell. On the gold side, focus on AI picks and shovels, semiconductors, data centers, and equipment. On the value side, lean into dividend-paying financials and energy resilient to high interest rates. For fixed income, the Federal Reserve's 3.5% floor allows investors to lock in yields between 4.5% and 5.5% and high-quality bonds. Avoid long-duration bonds, which are sensitive to volatile inflation. The optimal strategy focuses on short and intermediate-term maturities under 7 years. By moving away from passive inertia and adopting an equal-weighted, factor-driven approach, investors can use high market dispersion as a tool for portfolio optimization.